everybody. I have my t-shirt on. Legends never die. Okay. That is because as a founder, you kind of need to have that mentality or you will die. Okay. Lots to talk about this week. I'm going to focus on investment because I know this is a topic this is very close to startups' hearts. It's been the strangest, craziest, weirdest year. And I'm not just talking about our new president and how things are happening from tariffs to everything else. I'm talking about the public markets and the earnings season that we're expecting to see, which I think is going to be disastrous. We're talking about the investments that are going into early stage founders, which we're continuing to see drop. There's just a lot. And look, it's a tale of a lot of different cities. Like on one side of it, take India. India are doing really great right now, and they're pushing forward. And even though there is hesitation on companies that they don't see to be, driving revenue or whereby there's a fairly immediate access to revenue, there is still opportunity. In the US, it's very different. Things are incredibly hard in the US. Look at Europe. Things are incredibly hard in Europe. So I'm going to bring in a great investor in a couple of moments, and we're going to talk about angel investing, and we're going to talk about VC investing and everything else. But always at the beginning of these calls, I will give you my thoughts from the previous week with our founders and try and lead it out with that, and then bring in our guest, and then we're going to dig in to angels and VCs and what everybody's thinking. And as a founder, how are you going to be able to break through? Okay, so last week I was in New York on Tuesday and Wednesday. I was in Miami on Thursday and Friday, and I was in Bahamas on Saturday, and I was back in LA on Sunday. Now, am I doing all this stuff for the good of my health? No, I am not. I'm going over there so that we can continue to elevate our relationships with investors. What do I mean by elevate? Well, many of you as early startup founders will have the same situation as many VCs or many angels or many other people that are in the startup space. And actually, people who have jobs have the same problem. When you leave university, you go for your first job, you build your relationships in your first job, and at that moment, you believe your relationships are absolutely phenomenal. And those people become your new family. And then there's two types of people in jobs. There's the type of person who stays in their job. Now, for that person, it is extremely difficult to be able to leverage themselves very high in their relationships with the types of people they know. What do I mean by that? If you start off as an associate, leveraging a relationship would mean that the vice president of sales is not your best friend. Actually, the chief financial officer is your best friend. Actually, the CEO is your best friend. Actually, the chairman stroke woman is your best friend. That's what's called leveraging your relationships. And most people in a job find it very hard to do with that because clans hang out with clans. But the people who jump jobs all of the time, and they say, hey, I'm with this company in this area, but now I'm going to jump to a new company in another area. Those people are able to leverage to higher relationships. Those people understand the benefits of the 6 degrees of people that are around you and going up. So when I went to the Bahamas, I met with one person who's a phenomenal investor, incredible person, and somebody that I desperately want to make sure that we're very aligned with as we jump up to our next level of investing. Exactly the same in Miami, exactly the same with New York. I want you as founders to have this same mentality. The fact that you got an investor to put 50 or 100K into you today, that is not going to build you a unicorn. That just kept you alive today. So while you are managing your customers, and this is where we're going to start, and we're going to dig in a little bit deeper, because while you are managing your customers, while you are making sure that you're doing a good job with them to drive your revenue, because if you don't have any revenue, you're not going to be able to get the investors anyway. While you are managing your first investors who may not be the richest people in the world, but they were sure rich enough to get your company started, so they were very useful. You also know that your other 100% job is to make sure that you find the investors who are going to be the ones that can spend 1 million, 3 million, 5 million, 30 million, the amount that you need to be able to build a unicorn. And on that note, I am going to bring Pranav in, and we're going to talk angel investing, VC investing, startups, growth, unicorns, and all those wonderful people, all those wonderful things. Good to see you.
Hello. Thank you for
And
having
thank you
me.
for joining us.
I hope you can hear me fine. Yeah.
Yeah, I hear you okay. There's a little bit of an echo, but I hear you okay. I think we can probably we'll fight through. How,
Sounds
how,
good.
are th- how are things going with you? It's good to connect with you and good to be able to talk with a fellow VC investor about all of these incredible things, which are actually really tough for founders right now, because
Yeah.
a lot of founders are looking at the markets globally and they're not seeing what they saw in 2021. It's more challenging for them all over the world. So I would love us to have a talk about that. First of all, do you mind giving a little bit of an intro just to our guests so people can get an idea of your background beyond your phenomenal investment experience?
Sure. So I'm based in the capital city of New Delhi, born, raised over here.
He's got to go. He's stuck. Thank you, Kishley. Look, Pranav, I think we need to get you a better line because you're stuck and it's not coming through. But Kishley will let me know when you're good and we can get you back in again. I do want to talk in the meantime and really dig into this whole subject of how do we make sure that you're able to build like a proper unicorn, right? So I started a couple of moments ago, and everything I was focused on was how do we make sure that we actually take you from being very early stage and then building those relationships and getting them bigger and bigger and bigger and bigger. And it's all about the people you outreach to. It's all about the events that you go to. It's all about the parties that you're actually around. And it is all massively intentional, right? The stuff does not come on its own. And so I do want to get some comments about this when you guys are listening to it, so I can get a feeling as to kind of where you are on this whole journey, right? So let's see what we have. Okay, I have one founder which has just asked. Ooh, okay. I have one founder who just asked, how do I actually physically do that? Which is actually a great question because when I went over to the Bahamas and I went out with him and he showed me this house is where the Pritzkers live and this house is where these other folks live. And he lined everything up where I thought these are different worlds. These worlds do not collide. But the funny thing is, they do collide because we all do the same things. We all have the same bodily functions. We all have the same wants and needs and desires. We all like going to restaurants. We all like doing other things. Like, this is the stuff we all like doing. And so you have objectives and opportunities to be able to interact with these people, but you have to make sure that you put yourself in a place to be able to do it. So, here's what we're looking at. And I'm going to bring Pranav back in again, and we're going to see if we can get a better connection. I think he has one this time around. Actually, you know what? Let me bring him back in, and we'll have this conversation together.
Sure.
Pranav, how's that?
Good at my end. I hope that's fine for you.
You're looking great. You're looking great. You're sounding great. And so, a little intro, please, if you don't mind. And then let's get into a conversation about how do founders actually scale themselves up, not just say, because there's always this conversation about, I need an investor, I need an investor, I need an investor. But investors are like boyfriends or girlfriends or husbands and wives. They come in many different shapes and sizes and many different age. And you have to make sure that as you're developing through your life, the kind of people who are important to you when you're 13 years old are not the people that you necessarily want to be with. Not all the time, but some of the time when you're 35. Away you go.
Fair enough. I'll just complete the introduction, jump onto this topic as well. So, like I was saying, I worked in startups for about 3 years before going to my B school, then came back, did consulting, came back into startups again, and started angel investing and now manage funds, right? Um, taking a step back in the kind of startups I've worked at. So I worked at Uber, which is a listed company as well, and
Hmm.
saw the 10 to 100 journey, so to say, for a startup back then. Worked with an AI chatbot company before AI was popular. This was 2017, 18. And that's
Yeah.
when I saw a 0 to 1 company. And post my consulting stint, when I went back, worked with a media tech company, which is also listed now in the US. That's when I saw the 1 to 10 journey, or how the scale up happens and how do you prepare for IPO, right? So I think across all of these diverse experiences, I understood how the functioning of an org has to happen. I was angel investing in a personal capacity in parallel, where I built all my networks, and then combining the two, the networks plus the startup experience, is why I thought it'll be interesting to manage funds. Of course, raising funds is also an exercise one has to do. So learned it on the go in the last 2 years, and now today we manage about three fund vehicles.
Very
So
good.
just to
Okay, I
set
love
the
it. So
yeah.
look, funds, I know about funds. We've invested in a couple of hundred companies. You know about funds. You've both raised on one side of it and you've also deployed to startups as well. So let's talk to startups about how they can best manage this VC journey as opposed to just how do I first find an investor? Look, finding investors is fine. There's investors everywhere. And most of those investors, they don't call themselves investors. They just happen to be people who have 25K, 50K. They might have put it into the stock market. They might have put it into a second home. They might have put it into their existing home. And they also might put it into founders. So maybe we start there. But then what I really want to do is to be able to then talk about how do we then find the people who have $30 million, $50 million, $100 million, $1 billion, where those people, 50K, 100K, are an early stage founder is like a waste of time for them. But what they all want, what doesn't waste their time, is a company that can become a unicorn where they can get a sizable stake in.
You're right. So I put it this way, right? There are different type of investors which are there. Broadly, you can categorize these as private equity investors, venture capital investors. You have family offices, and then you have angels, right? Within angels, there are three categories, at least in India. You have angel investors who are doing it standalone. There are others who are probably doing it as a syndicate. And then the third category is those who are doing it as an angel fund, which is just one type of
I'm going to
angel.
add another category. I'm going to break. I'm going to just break it down only on my experience in the U.S. Right? I think there are two types of individuals. There are the types of individuals who are very, very small, and then there are the types of individuals who are very, very big. Just very, very big. That's what I'm talking about when I'm talking about like leveraging it. It's not just the funds. Most funds are not rich people, right? Most of us, we manage other people's money. If we were rich, we would manage our own money, right? But we manage other people's money. But that's okay. But the amount of money that we have will dictate where it goes to. But like if we just break people down today and we're like this guy I met, he's worth easily $1 billion, right? My limited partner is worth easily $1 billion. Like, and then most people are not, right? Most people, if they're worth $20 million, that's an amazing life that somebody has led. But those people are not rich in the world of early stage founders, right? They're the people you kind of go to at the very beginning. And it's then how to manage that step to be able to get someone who has $1 billion to actually notice that you're important. But please keep going because in that categorization of the first group, I think everything that you've said is 100%. I'm like 100% aligned with. Some of them are syndicates, some of them are SPVs, but they're just the smaller ones. I just wanted to add that fourth group of like the monster, what we call ludicrously important people. These are the
Right.
Peter Thiels of this world. They're the Tim Drapers of this world. They're the Donald Trumps of this world before he became a president, right? They are ludicrously important and they get their own sector.
Agreed. And I think the same holds true even for the Indian market, wherein you will have people who are ready to. Recently, I was talking to somebody. He got a $5 million term sheet from a single investor, which was a family office, which was rather unknown, which was a listed company sitting in Mumbai, which is the financial capital market, right? So the same categorization works here as well. We, of course, spend a lot more time with let's say, aggregating the smaller ones so that their check becomes more meaningful. But there are two types even in the large checks. One is, let's say, successful founders of unicorn companies who are now putting back capital into the ecosystem. For example, one of the most famous companies for food delivery in India is Zomato, right?
Yeah.
Zomato is a listed company. The founder of Zomato is also investing in a personal capacity, right? We have the equivalent of a Shark Tank, which is happening here. People coming on Shark Tank are also cutting out checks every day. They're putting a sizable amount of their net worth to this exercise. But again, they are the nouveau rich, the new money. Then there's the old money layer, which is not visible, which is actually cutting the $5 million, the example which I was giving, right? And those are family offices you don't hear of every day. They're not in the newspaper, they're not in the discussion area, so to say. For example, tomorrow I'm speaking to a family office which has been probably behind the real estate of the richest city in India for the last 150 years. So that's the kind of capital one elevates to. What's interesting is, even in a market like India, they're opening up to private markets and early stage startups very actively. Having said that, I think to your earlier point, it is not 2021 for anybody, be it the small ones, the big ones, the funds, VCP, everybody. I think there has been a rationalization since 2021 and now. So the way we typically look at it is 2021 was an aberration, but if you remove 2021 as 1 year, the rest of the trend is still in one direction.
Yeah, yeah, I agree. There's such good points. And you know what was amazing to me? I saw this statistic last year where there were something like 100 new billionaires in India over like a 12-month period. And so that's what's so crazy about this and why like that group is so incredibly important. And I think 5 years ago there was rich people, but there were so few of them that the chances of being able to get into a Bill Gates or a Steve Jobs back is very, very, very small, right? But now you have not just like Steve Jobs' trust, which is probably, I don't know where it went to because I don't think he had one kid, I think, but I'm sure there's cousins and uncles and aunts and all kinds of things. But then you have Steve Jobs' wife, and Steve Jobs' wife, like on her own, that is probably 20-25 billion dollars. And so now you have Jobs' wife's brother and friends and uncles and all of these people fit into a category. So I think number one, this is a huge group of people that have really got the capability of the VCs of tomorrow, because a $5 million check really doesn't move any needle one way or the other if they lose it. And I think the second thing that's really exciting about this group of people is that go back 20 years, it was pure real estate. Like it was real estate, maybe it was energy as well. You could throw energy in there too, but like it was real estate and energy. Now the kids are coming through, and the
Yes.
kids are saying, well, I understand crypto. And if you'd have listened to me on crypto, I would have outplayed your energy just with Bitcoin. And now, but I really like late stage venture. Do you see how NVIDIA grew from like when they were at this stage, but you only get in at this stage? Why don't we go there? And just by association, the early stage space has been included in here as well.
Agreed, 100%. And I think last week I was speaking to someone who manages, you could say, nearly $4 to $5 billion transactions per annum as a setup in Mumbai. And they said as well, they're actively investing. They've done a fair bit of late stage. Now they're thinking of early stage as well, right? Today morning, I spoke to someone who's a successful founder, exited his company to Shiprocket, which is one of the largest companies which is looking to go public as well in India. And he's invested in about 10 odd funds as an LP. So there is increasing awareness amongst domestic capital for private markets. That's also reflected in the public markets if you track the Indian market, right? While FIIs are pulling money out, domestic investors are actually pumping more money in the stock market, which is helping sustain the current market valuation, so to say. And the fact that there is an interesting interaction between public markets and private markets, wherein public markets are, let's say, seeing a correction at the moment in India, given the rise of markets in the US. Private markets are now becoming more lucrative. So it is interesting times across the board.
Very interesting times. And also, it also because the public and the private markets changed, right? There was like there would, when Microsoft went public back in the day, I think they went public at like 100 or 200 million dollars. And that was a pretty massive public offering back in that day. Now they would laugh at that as the private markets. Like that's a Series B, maybe even a Series A for some companies at a $200 million valuation. You still have to go through B, C, D, E, and F in some cases. So when Coinbase went public, they actually went public at $100 billion. And so here's the great news for everyone who's listening to this as an early stage startup. It's not that the market has become harder. Actually, the market is easier for great companies. There are way more rich people today. Now, if we're talking societally, it's probably worse because the gap in the middle has become really teeny weeny, and there's poor people and there's rich people. But if we're speaking just for startups, you guys are on fire right now. You have got more wealthy people in the world that there's ever been before, and there's more people who would have invested previously in the public markets that are now the private markets, which is your markets. Good news, good news. The
Yeah.
bad news is there's more noise. That's the bad news, right? There's tons of noise out there right now. And investors are so used to founders lying with their whole revenues go like this that like nobody believes anyone. So, how do founders overcome this? I have some thoughts, but I would love yours.
I think as early stage investors, so a couple of points there, right? One, we don't talk TAM because at least for the Indian market, there's enough TAM for anybody building in the consumer story. If you talk about SaaS, if it's global, it covers a large enough TAM. So we say, don't try and sell us the TAM story, right? Tell us
Yeah,
how will this solve a real problem? Are there takers for it? Will they pay for it? Is there enough money to be made? Can you make this money scalably?
yeah,
If somebody comes and tells us honestly that okay, this is a 1,000 crore business which is probably 1/8 of a unicorn and not the next unicorn, I'm okay with it as long as they're being honest to themselves. What is the business they're building, right?
yeah,
And I tell them all the time that, and I was discussing this with another VC today during the day. He's set up $100 million fund. He's been a successful founder himself. He's been a corporate venture capital partner earlier as well. He said the same thing. He's like, there are successful businesses, and I tell a lot of founders don't raise capital. If you think you will build a lifestyle business, if you think you can build a venture business which is potentially a unicorn business, then that's
yeah,
good. That's when you raise capital, right?
yeah,
So founders need to be honest, and they need to break it down on a business case basis, is how
yeah,
I would say it, right? Fundamentally, you're building a company. A company needs to do business, that business needs to make money, and that money needs to be creating a certain value, which will let the investors make money as well. So I think they need to be true to that. In comparison, of course, there will always be five companies for every person building in a subsector or in a niche as well. And that is true for India, where you have such a high population. You find 10 people building the same thing. What really differentiates is the clarity of thought, the kind of execution, and the hustle they're putting into it. And that's what matters at the end of the day, right? Of course, you judge a product company differently, a service company differently, and you judge an AI company very differently.
yeah. Yeah, I think that's phenomenal. And I also feel that relationships have become more important than ever before. Like investors are now, there's so much money involved, and people are so used to being like, it's almost every large investor I speak with has at some stage had somebody defraud them, steal from them, lie to them, and that's even outside their relationships, right? And so it's a very, very difficult time, and it's a very noisy time. And so, actually, as a great founder, and remember, we're only talking about venture backable founders on this particular stream. Like, if you're a small founder, you're building a nice lifestyle business, God bless you. The things I'm talking about and we're talking about here are not that relevant. But if you want to build a unicorn, it means that you have to raise probably 30 to $50 million at some stage. And if you're going to do that, you need to know how to raise 30 to $50 million. And to do that, you need to know the people that you're going to raise that from. And that needs to start a pre-seed, right? Because there needs to be clues that you have the ability to execute at the very highest level, and you're not going to be afraid of when it happens. And so for me, everything is just about building relationships. It's just a relation. You got to start early. You got to add value. You can't be that person who's just always pinging someone. Do you want to invest now? 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 I think that part of it is one. I'll throw two pieces in, and then I would love your thoughts on those pieces, and then also any other pieces. I think number one, really build relationships and understand it might take a year, 2 years, 3 years to build a relationship properly. And building relationship with an investor, a large investor for the future, is no different than building a relationship with a future romantic partner. You have to do it in a way that's of value to them. If it's just always of value to you, then it's okay. Number two, people only trust people who have other people like them trusting you, right? What do I mean by that? I mean that if you're in school and you're saying, I'm like the greatest tennis player in the world, and no tennis players know you, play with, or have anything to do with you, then the chances of that person playing tennis with you is pretty slim because you're probably not the greatest tennis player in the world, right? If you're the greatest startup in the world with the greatest idea, with the greatest unicorn potential and everything else, then why is it that other people like that investor have nothing to do with you? Why are they not on your advisory table? Why are they not speaking about you? Why can't you talk about them when you're referring to that first person? It all becomes this thing here. Thoughts?
Agreed. I think relationships are very important. It's something which is a two-way street, for example, right? For us as investors, we need to share value, and it's not just transactional. To give you an example, two parts, right? There is one founder we met in 2023. We passed up on that company. Today we are investing in that company. Another company in 2023, we met them. We passed on them after taking them almost to IC, and with a lot of heavy baggage, we said we'll pass this time. We're investing in that company today. Both of those cases was the founder was open to a conversation. There was no resentment, no hate, and no arrogance around it. And in between, they did manage to raise a round. So we said no, they raised a round. They've come back and they're taking capital from us still. In the process, the good thing one of those founders did was he kept in touch, shared updates about the new centers they were launching. He was not only sharing updates with us, he was sharing it with 10 other people who he knew he will have to go back to raise capital in the next 18 months.
Yeah,
Today, he doesn't need a deck to come and pitch to our IC because we've always been updated with what he's been building. And the ICs interacted with him the first time round. So the second time round, they didn't ask for a deck. Then it was more, what is the update? How's it going? What do you need the capital for? What's the next steps and plan? And it was less than a 30-minute call, and the IC approved it. Whereas the first time around, it went for 90 minutes. So I agree, relationships are very important. Trust is very important. People need to believe in you. Going back to the previous point you said about integrity, ethics, good governance and practices, right? It is very important, and it
yeah,
holds true for fund managers as well. One of our fund advisors always tells me, and he manages nearly $2 billion private equity fund in India, right? And he told me that, Pranav, LPs will not hold you if you invest in a bad company. The investment judgment can go wrong, or the businesses may go down, but they will hold you against lack of compliance or lack of ethics or any conflict of interest. The same bar, hence, investors have to hold with founders as well, right? So
yeah,
for us also, that's true. The first sign of a red flag we see in a founder as a person, in terms of personality, in terms of their dealings with the team, dealing with other investors. We've had scenarios where founders have come to us and said, okay, we'll be nice to you, but we are abusing our other set of investors. That doesn't give me confidence, right? Because ultimately, they've put faith in you as well, right? So, the right dealing with your board advisors and with your investors, it has to. Yep.
I like that. Okay, cool. I want to, you actually layered on, just before we answer this question, you layered on, I think, two very important pieces. Like if I had said trust and building relationships, right? And building relationships are like a longer thing. And then people have got to trust the people around you. It's not even that they have to trust you. You will be trusted by the people who associate themselves with you. So if I go to Peter Thiel and Peter Thiel knows that Tim Draper is my friend and that maybe a Steve Cohen is my friend, or at least I know them and they know me and trust me, then the chance of trusting. But you brought in two extra pieces, which I really like. You brought in communication, because the fact that I have those people, if I'm not dropping these subliminal points to impact your future decision making, then what's the point, right? It's not even there. So the communication is really important. And the other thing that I really like that you said there is the execution, right? If it's one word I condense it to, it's execution. Those founders that are following up with you are saying, look, I'm going to do this. And as an early stage investor, we don't know whether they are or whether they aren't. We're guessing. I think even diligence is like such a hard word in the early stage community. We're purely guessing on the execution power. But then the founder executes and communicates constantly. And communication is not one email. Communication is what you would do with your mom, right? It's the fact that she knows on a daily, weekly, bi-weekly, monthly basis, whatever is that perfect cadence for communication, whereby the other person feels special and thought about, is what you need to have in place. So I really like that. And I think that's really cool. So look, there's four things as founders, four things that you have where you know that if you manage people like this, you're good. Let's move to what Divya is saying here. Noticed any major shifts in founder investor relationships compared to previous years?
There is a more coexistential relationship. There was a phase in between where a lot of corporate governance issues were coming up, but now people have realized it's important. Founders have accepted it, investors have accepted it, and they're together trying to forge relationships with each other, trying to ensure that it's the best business outcome for both parties involved. I think it is a more honest conversation now from the get go. Earlier, it was more a guessing game between the two, but now it's
Yeah, and we're having. I'm gonna put them out and I'm gonna bring them back again. Okay, so we're having a little bit of connectivity there again, but I think look, the point that he's making is a very important point, right? We have right now, we know that if we've got a founder who is actually, let me just step back a little bit. In 2020, everybody was saying they could do everything, and VCs had loads of money and investors had loads of money. And because they had loads of money, then it was like it was very difficult. Like some people won, some people lost. That's the way it was. When the market tightens up, what happens is then you've got a situation whereby you how do we say it? The cream rises to the top is maybe a really good thing. And I think what we're seeing in this market is the cream rises to the top. And this is why people always talk about how recessions, they talk about a cleaning of the water. They talk about like better quality, cream rising to the top. And that's because the founders that just have the stories, they very seldom break through. 90% becomes just about the thing. And so the great thing is, look, if we've gone through trust, we've gone through relationships, we've gone through communication, and we've gone through the execution, then maybe one really nice one that you've layered on there is the fact that the more, and actually, you know what I'm going to do? I'm going to bring up Ashish, because Ashish also mentioned this in a really nice way. And then I'm going to bring Pranav back in again. And so the big thing here is when I say execution, it goes even further. And profitability is not actually the important piece here. The important piece is cash flow optionality, right? Cash flow optionality. So nobody wants you to be a profitable company, but people want you to be able to be a profitable company if you so chose to do so. Why does nobody want you to be a profitable company? Because you got to grow to unicorn stage within a 6 to an 8 year period. That's the timeline that most people want you into. But I think this is a fascinating conversation because You don't want to go one way or the other. You don't want to become a company where you're making enough money to go on holidays 3 times a year. No VC wants that. The game you're in is about getting the maximum return on opportunity. But at the same time, also, nobody wants you to be a company who is constantly asking for money and has no ability to be able to drive profits. And I think actually that's singularly the biggest change over the last 15, 24 months than any time in the last 5 or 6 years. What do you think?
I agree. I couldn't agree more actually about this point that after 21, 22, it's become very important to have a path to profitability. It could take 2 years, it could take 2.5 years, 3 years, but it is required. And especially in most sectors, for areas like deep tech, maybe it is okay to take about 5 years to talk about profitability and 2 years to get to revenue. But in all other spaces, you want it much more earlier. In consumer businesses, only within a 12-month, at least two level, certain margin level. Whereas in case of fintech businesses, maybe by year number three, you want some pathway towards profitability. And agreed, if you're building a nice profitable business, take money home, but it's not go big or go home, right? So that's what venture is for. So if you're not building a scalable business, then it's not for venture.
Okay,
But
perfect.
I think a
Well,
lot of
look, your
emphasis is being
signal
on
is still
profitability. Also
your
because
signal is still a little bit bad. I gotta kick him out. I'm sorry, Pranav, but we got all of your points. You were epic, and even though we lost your signal at the end, everybody got it. And I will have you back again for sure. And I appreciate you jumping on. And look, I think if I'm gonna just, because I know it was getting choppy there at the end, if I'm gonna just put it into in a very succinct way, if you're a founder and you're building a company, you've got a couple of things that you want to do, right? You want to be able to grow at 200% growth. That's the first thing that you want to do, right? So let's say you're $30,000 a month in revenue. Well, then you want to be able to get to $90,000 a month within a year period. And if you get to $60,000 a month, it's okay. But the following year, you want to be able to grow that 60 to 180, right? But then when you get to 180 a month, then you're saying, okay, I'm at $180,000 a month. How do I take that up to 540? But let's say you only get to 360, which is 100% growth. That's okay, because the idea of raising the money is that your growth keeps on going up. You're growing at somewhere between 100 and 200% every year. Will you have one year at 25% growth? Yes, but then you have to have another year at 200 or at 180. And then you have to have another year at 200 that you're going to bring in there as well. Like, that is the game that you're playing. That is the beginning of the game. That is game stakes. You got to be there. The part of the game that has been introduced over the last couple of years and always gets introduced whenever markets get a little bit tight and there's not quite enough money out there, is that people want to be able to make sure that if you are one of those companies that are raising a lot so that you can keep on growing your revenue, then you at least have the ability to make sure that you can reverse it back again. And if you needed to, if the market got crazy tight, then you're going to be able to survive, right? It's maybe the greatest tragedy when you have a phenomenal business which is so outsized on its expenses versus its revenue. Like, you grow so much on the expenses side of it that even though your revenue is growing at 200%, your expenses are growing at 400 or 500%. The market suddenly goes really bad. Your investors get unlucky, nothing more than that. They can't put back in again. The new investors are going to wait for a better market. And suddenly, your valuation is no longer $1 billion. Now your valuation is like $200 million, and you are desperately trying to fight the down cycle. So I don't call it profitability. Don't use the term profitability, because you don't need to be profitable when you're going through hyper growth. It is cash flow optionality. And if you can show that you have somewhere between 100 and 200% growth, and you can show that you have cash flow optionality that you could go for if you wanted to, but it will bring your revenue increase down, maybe even to a flat year, that is okay. Because at times like this, like, I think I heard something crazy like something like 80 to 85% of all companies that had raised money in 2021 are coming up with a cash flow major challenge in the next 6 to 9 months. What does that mean? It means it's going to be a horrible crash for those companies, and they could be great companies. So you don't want to be that Greek tragedy of where you are. Okay, let's see what else we got here. We got some great questions coming up. What weighs more for the chances of a company becoming a unicorn, the founder's execution on the journey, or the business model, scalability, and market trends? Oh man, it's all of them, right? Look, in the early stages, this is like early and late stages. As you grow to a series D, E, F, you're bringing in $1 million, $3 million, $5 million, $10 million a month in revenue. That company, you have to almost manage it like you're a human resources director. At the very beginning, you have to manage it like you're a barbarian at the gate, right? So everybody wants to see, do you have the ability to be able to build a market out of nothing, right? At the later stages, and maybe it's even after Series A, everybody just wants to see, are you a great builder? Barbarian, builder. While you're at the beginning, be a barbarian. Don't be sitting all day doing OKR meetings and talking to everybody about how great they are and doing performance reviews and making sure 90% of your time is spent making sure that you're in a good place. Focus all of your time and energy on growth. All of it. Don't even worry about the profitability piece at the beginning. You don't have time. You're pre-seed, seed. Your job is to capture market share. And remember the two things, maybe the three things. But the first thing is, if you're not doing monster outbound, you're not going to capture market share. We all see that as VCs. I don't care how good you are. I don't care how good your product is. I don't care how big the market is. If you're not spending 50, 60% of your day doing outbound, you're not going to be able to capture enough customers. The only exception to this rule is rich little boys who go to nice schools, right? Rich little boys who go to nice schools whose mommy or daddy works in a VC, those people don't have to worry because their mommy and daddy are going to buy them a unicorn for their 18th birthday. But for the rest of you mere mortals who did not do that, you have got to be barbarians at the gate. And then when you get to a stage of scale, and you literally don't have another minute in the day, that is when you become a builder. But that's when you're getting to $100,000, $200,000, $300,000 a month. I love the question though, because all of these areas here are really important, but it starts with execution, and the execution starts with intent. You could be an executor of a small amount, but if you're an executor of how you get to 100 to 200% growth every year, you get a unicorn for free. Think about it. The math gets you there, right? 20K a month, 20K a month gets to 60K a month. That's 200% growth. 60K a month goes to 120 a month. That's 100% growth. 120 a month goes to 360 a month. Boom, we're up at 200% growth again. 360 a month goes to 720 a month, only with another 100%. 720 a month brings you to 1.4240 a month. And so now you're at $1.44 million a month. God bless you. You just hit a Series B round. Okay. Now, at all of these stages, you're raising money as long as you're growing. If you're not growing, you're not going to raise the money unless your investors are idiots. And all we're saying about the profitability thing or the cash flow optionality thing is bear it in mind inside to make sure that you're not losing focus of the fact that you could be building something absolutely incredible, but your costs are way outsizing everything else. This is why I like flexible office space. This is why I like outsourcing staff. This is why I like, building teams with incredibly smart people in places like India, maybe not necessarily doing it in San Francisco. So Shreya's come in here with Indian private equity investors often prioritize profitable exits. Yeah, because they're private equity. They're private equity. They don't want innovation at that stage. Remember what a private equity firm does. 1 + 1 = 2.5. That's their job. So 1 + 1 = 2.5. So they don't want innovation. They just want to take something that's really broken here, maybe a little bit broken. I'll give you a great example. I had a private equity firm come and they wanted to combine two cybersecurity companies. One had terrible team. The other had incredible team, but product was just okay. They want to just glue them together. They want to get some super glue, put them together. They don't care about innovation. They just care about their thesis of the extra 0.5 being correct. Okay, let me look at the second part of this. How is Expert Dojo introducing the US investment approach, which emphasizes innovation? Well, first of all, we're early stage, so not private equity. And so think about investors like this. You have, and we talked at the beginning of the call about like really strong early stage, like very rich people. And how do you get to very rich people? And how do you have those people seeing that you're of value? But if we break it down into the different stages of investors instead, and we say early stage investors, it could be any one of the categories of VCs and angels or funds or syndicates or anything that could be early stage, but it's an area that we decide on. Our world is normally companies that are doing under 50, 60, $70,000 a month in revenue, whether it's recurring or non-recurring revenue. That's where we live. That is in the pre-seed space. Sometimes we will do a pre-product company, but hardly ever. Most of the time, we're measuring growth because we're growth hackers and we're a VC, right? You then have companies that are like your seed investors. Those people, again, they can give two hoots about like investment approach. All they care about is that barbarians at the gate. Then you have Series A investors. Those investors care about something very different. They care about a team that is able to build out a company that is capable of being at $1 million a month in the shortest time scale possible. That is much more about measuring who are the people who are actually leading this organization and their ability to break through than it is barbarians at the gate, growth, 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 growth. Those companies, that cash flow optionality piece becomes more and more and more important when they're doing. And then you have later stage investors, and the later stage investors already know they have the team. What they now just need to make sure is they have a very strong, repeatable model that just puts them into a really strong place. That's all. So you just want to know, who's your person? What world do they live in? What do they care about? How do you find out about that? It's written everywhere. It's on their blogs. It's on their website. It's on their LinkedIn posts. It's in who they are friends with. You know, you can tell if there's somebody in San Francisco who's hanging out with all of those folks that I was talking about before, like the biggest people in the world, the folks that are like the top people in Sequoia, top people in NEA. Well, sure as shit, those people are not going to care mainly about very early stage companies that are not doing any growth. That doesn't mean you don't approach to them, but it does mean that you understand what makes them tick, what is important to those people. Okay, so know your investor. That's all. That's the underlying answer to all of this. Know your investor. And look, I'm going to finish it with this. And hopefully you've taken some things from this. Hopefully you've taken the 4 or 5 really strong characteristics that you need to make sure that as a founder that you're demonstrating to build investor relationships. I think it was trust. And then you got to make sure that you've got your execution. And then you've got to make sure that you have your communication that you're building as well. And like you're building these things around, you're communicating with people in a way that they can feel more safe and secure around you. These are not one-night stands, these relationships. These are longer-term relationships that you're building. Number 2, you're building the relationships for the investors that you need today, that you need for tomorrow. But you're building those relationships now in the knowledge that those relationships may take 1 year to 2 years to build. That is part of your job. Number 3, you are going after 200% growth, period. Every investor in the world knows 200% growth is a win. Under 100% growth on too many years is too long for a win to happen. It doesn't mean they can't become unicorns, but you want them at that inflection point. Think about Airbnb. First 6 years, nothing, right? But if you could have got in there when Y Combinator could have got in there, you didn't have to tie your money up for 6 years. Ba-boom, they went high. Even if you look at Y Combinator, the first couple of years, they did nothing. But now every investor in the world wants to be around them. Why? Because they hit their inflection point. So people want to be around those folks. And finally, just know your investors, okay? You need investment mainly to build a venture backable company. You also need incredible customers who love, respect, and want to be around you. Build both. Anyway, I'm back here every Monday, so don't worry, you got plenty more questions, but remember, I have 2 advantages to you for running this stream for you. And it's the 2 reasons I do it for you every single week. I have personally, through Expert Dojo, invested in over 300 companies. That means that there are hardly any people on this planet who have engaged as deeply as I've engaged with as many companies that we've invested in. I have seen the tragedy, I've seen the breakthroughs, I've seen the utter flukes, I've seen great fundraisers, I've seen terrible fundraisers, I've invested in both. That's on one side. On the other side, I have a unique insight with regards to growth for venture backable companies because that is what Expert Dojo specialize in. So when we invest, that's what we look for. Now, we are opening in India. I love the fact that we have so many Indian people that watch this actually, but we're opening in India and I am beyond excited. I don't want us to own India and I don't want us to own the United States. I want us to own the bridges, the toll roads in between for founders who are looking to dominate in each other's markets. That's what we're going to be investing in. And Ash, who's our GP of our fund over in India, he's taking applications today. We will do our first cohort in July and it will be a doozy of a cohort. So anybody who's looking for investment, remember, that's what we'll do. Okay, I'm done. Have a great week. Go out there, build investors, build startups. If you have any recommendations of things that you really want me to dig into on this show, let me know. Ping me with an email at brian@expertdojo.com. Remember, this is for you. It's not for me. It's not for the dojo. It's for you. I want you to learn how to build venture backable companies. I want you to understand who are the players that are in your space. And I want to finish by thanking our wonderful guest who was here today, who had some incredible insights, although a little bit of a dodgy internet connection, but incredible insights all of the same. And thank you all for joining. I'll see you next week. Come back on. Feel free to tell friends. Anybody who wants to join this, as I said, it's for you. If you have a question about your startup, feel free to ask that question while I'm doing it as well. This is your time, okay? Okay, with that, go out there.